Most traders think they need a perfect trading strategy or a secret indicator or a $999 trading course to become a profitable trader. But they all are missing this one thing which no one talks about, and this is the only thing which separates professional trader from retail loser. It's risk management. I don't know why risk management is so underrated topic even though it's the backbone of profitable trading. No one can ever become a profitable trader without having a proven risk management system. I promise you, at the end of this video, I will give you a proper risk management system which will help you end your big losing streak, scale your account consistently, and most importantly, become a consistently profitable trader. Some retail loser will say,
Bro, it's useless. I have a secret ICT trading strategy which have 90% win rate, and yesterday I made $10,000. I don't need risk management.
"Oh really? But how will you survive if you face back-to-back 10 losses in a row? Because neither you, neither me can control the market. Anything can happen in the market. So it's better to be safe now or regret later." So to make this video even more powerful, I have divided this video into 3 parts. Number 1 is money management, where we will understand how to manage our capital in losing streak and how to scale it in winning streak. Number 2 is trade management, where we will understand the technical chart work of risk management. And number 3 is summary, where I will quickly summarize all this topic. So without any further ado, let's get straight into the best risk management course ever built on YouTube. Before you open this chart, I have to ask you one question. Are you actually here to change your life, or are you just looking for another dopamine hit? Because this next 30 minutes isn't entertainment, it's the blueprint. If you can't log in, close the tab right now. Go back to TikToks, go back to watching get rich quick strategies, and go back to lying yourself that why you aren't profitable. Because if you can't sit through a 30-minute guide that literally dictates your financial freedom, let's be honest, you aren't built for this. If you wanted to stay exactly where you are, broke, confused, and unprofitable, leave now. But if you are tired of being a spectator of your life, full screen, phone away, pen out, let's get to the work. Welcome to Risk Management Masterclass 101, and here are the 4 topics which we will cover in this full video. Number 1 is risk per trade. Number 2 is ceiling. Number 3 is risk to reward ratio, and number 4 is trade management. We will go to them one by one, but our first topic is risk per trade. What is risk per trade? Risk per trade is the amount of money you are willing to lose on a single trade. It can be 1%, 2%, or anything you have to risk. But the journal rule is risking 1% to 2% per trade. This is the journal rule which trading industry follows. 99.99% of people follow this journal rule. But I have a special rule which says that if your account is at break even, for example, you are using a $100,000 account and it is at $100,000, you will risk 1% per trade. But if your account is down 2%, means your 100,000 account goes down to $98,000, you will decrease your risk to 0.5%. Means if you are risking 1% per trade when your account was at break even, once the account goes to down 2%, 98k, decrease your risk to 0.5% per trade and be at 0.5% until your account gets again to 99 or 99.5k. Means if your account is down 2%, decrease your risk to 0.5%. Again, increase to 1% once your account goes to 99 or 100k. And if your account is plus 5%, means if your account is 5% in profit, if you are using $100,000 account, if your account is at 105k, increase your risk to 2%. Yes, if you are risking 1% per trade when your account is at break even, once the account is in 5% profit, increase your risk to 2%. This risk management framework will help you scale your account faster, be safe from drawdown, and be safe from blowing your funded account and live account. And especially it is more specifically like a funded account strategy, but you can also use in live account, because me personally using in this risk management framework in funded account, it helped me a lot. being safe from blowing my funded account even after 12 losses in a row. So this risk management framework works. So let's get to an example of a person named Andrew. Okay, so there is a person whose name is Andrew and he is an unprofitable beginner trader. He came to the market and started risking 25% per trade. He risked 25% per trade because he wanted to get rich quick and buy a Lamborghini for himself. Then his losing streak hit. He lose one trade. Now he is down 25%. Okay, he again lose one trade because it's common in the market. You can lose again and again and again. So again he lose one trade, and then again he lose one trade. Now he is down 75%. And because the market conditions are so volatile, he again lose a trade because he is trading based on emotion, not on system. So at the end, let me make my chart there so I can show you this. Okay, now after losing 4 trades in a row and he is risking 25% per trade, his account has been blown. He has lost 100% of his account in just 4 trades. That's why beginner traders lose in their first and second years of trading because they doesn't follow risk management. They started risking 25% per trade just to get rich quick. Comment down below how many of you are risking 25% or more per trade in your beginning. Me personally risking 10 to 20% per trade in my beginning. So if you are not Andrew, start risking 1 to 2% per trade or the risk management framework which I gave you, because it will be more better, because it will save you from blowing your funded account and help you scale your account faster. But to measure your risk management, risk per trade, you have to calculate your lot size. So let's get to the position size calculator and understand that how to calculate your lot size. So we are on a position size calculator and we will understand now that how to measure your lot size so you can manage your risk effectively. So this is the position size calculator of my FX book. So firstly, we have to select our currency pair. So for example, I will select my currency pair as Euro USD. Okay. Then your account currency. If you are trading on another account, you can select here. If you are trading on AUD, you can select it. But I am trading on USD and most of you I think are trading on USD account. Your currency is USD. So select USD. And then you have to fill what's your account size. So for example, I am trading on $5,000 account. But for example, being simple, I will take $100,000 account. Okay. Now your risk ratio. How much money are you risking per trade? What's your risk per trade? For example, to be simple, I will place here that we are risking 1% per trade. Okay. Now what's your stop loss pip? Now for this we have to go on our charts. So let me take my replay tool and then measure it. So I put my replay tool here and made the chart go to backside. Okay. And now we will measure our pips. Yes. So for example, this is the chart and this is the point of interest where we wanted to enter. Okay. Once the chart came here, and we make our entry here. After a liquidity sweep, we make our entry here, set a stop loss here and set a target here. Now we will wait for it. Now, but before entry, for example, a chart is here. Before entry, we have to measure a lot size, that which lot size we are trading for. So for example, I have planned to enter here. My stop loss is here. How many pips are there? So I will come here, click the shift key in my keyboard and then click on the charts and then measure my pip. So this is 44 pip. Now I will come to my position size calculator and fill that this is 44 pip. Okay. Now what is trade lot size? It is, for example, so don't fill here, it is 1 and let it be 1. Okay. Now we will click on calculate and it will give you that how many lots you have to take. So it gave me that I have to take 2.27 lots. So this is the lot size you have to take on your account, and it also gave you that how much money are you risking. So I have filled here that I have to risk 1% per trade, therefore they gave me that 1% is $1,000. And then this is the size which we have to take, and only trade what lot size your position size calculator give you, because that is where it is on system, because you are risking. If you are managing risk, you have to measure your lot size and trade based on your lot size, not randomly taking 10 lots and 20 lots. If you take like that, taking random lot size and not managing your risk, you will blow your funded account or live account very faster. Now let's get to point 2. But before going to point 2, let's see which trade we took is winning or losing. Oh, it win. It means you have to subscribe my channel. Subscribe the channel right now and hit the like button right now. Let's get to point 2. So our second topic is ceiling. But what is the ceiling? Ceiling is the roof of the house. But where is the house? Where is the roof in trading? In trading, the roof is your rules, your boundaries, which will save you from blowing your account, because Warren Buffett says, being in the game long enough so that compounding do its work. Therefore, we have our 3 rules. What are the 3 rules? The 3 rules are max trades per day, max losses per day, and fixed trading window. We will go to all of them one by one. So our first topic is max trades per day. So by blowing 7 live accounts and 2 funded accounts, I saw that the best rule is only taking max 3 to 5 trades on a single day. But before it, let me explain you what's the max trades per day. What is it? Max trades per day is the amount of max trades you are willing to take on a single day. It can be 10, 20, anything. But by seeing my data, by blowing 7 live accounts and 2 funded accounts, I saw that the best is only taking 3 to 5 max trades on a single day. Don't ever take more than 3 to 5 trades on a single day, because it will let you take over trade and taking revenge trading based on your emotion, not on your system. So if your data says that you can take more trades, 5, 10, 20, anything, follow your data, not my fluff. Okay. So max trades per day rule is also important, because it saves you from over trading, revenge trading, and taking random trades just to recover your loss, and just taking trades out of boredom. Therefore, follow this rule. Have a fixed amount of trades max on a single day. My recommendation is only take 3 to 5 trades on a single day. Don't ever take more than it. Even if you are seeing that the chart are moving so fast, I have to take trades here, but you have took 3 to 5 trades on a single day, close your PC, close your trading account. Don't look to charts again just because the chart is moving so fast and you have to trade there. No, if your max trades are hit, you have taken your max trades, close your PC. Don't look to the charts again. Now our second rule is max losses per day. Max losses per day is the same as max trades per day. Max losses per day is how much max loss you are willing to take on a single day. The max amount of loss you will take on a single day. So most beginner trader do this mistake, that they don't have any max loss per day. If they lost 5 trades in a row and they are risking 1% on a single trade, they lose 5 trades in a row, they have lost 5%, and then for recovering their loss they take more trade, and eventually blow their account, and then say, why I am taking that random trade? I don't have to take that random trade, that's not on my trade plan. I am just taking that trade on emotion. This is because you don't have a set of rules. So my data says that the best amount of max losses per day is 2 to 3 losses on a single day. If you lose more than 2 to 3 loss on a single day, close your PC. But in percentage wise, let's say for a journal rule which many people follows is 5%. 5% drawdown. Yes, 5% drawdown. If you lose 5% on a single day, close your PC, close your trading account. That's what journal rule many people follow. But by backtesting hundreds of trades and blowing 7 live accounts and 200 accounts, I saw that the best is only losing 2 to 3% on a single day. If you lose more than 2 to 3%, close your PC. If you lost today 2 to 3%, close your PC, close your trading account. Don't look to the charts, because my data says that 2 to 3% loss on a single day is best, because it saves you from over trading and revenge trading and taking trades based on emotion, not on system. That's what my system says. But the general rule trading industry says is 5% drawdown. You can follow any of them, what your data says. Don't trust me, trust your data. Okay, what your data says, follow it. If your data says that you can lose your max losses per day is 10%, follow it. Your data is real, not my fluff. Okay, even I am saying on data, I am not saying anything which I know. Everything I am giving you in this video is data backed, not anything which I am pulling out of my ass. Now, fixed trading window. This is so important. I think this is the best thing which saved me to blowing my accounts. Now, fixed trading window is the set of is a fixed trading hour, fixed trading session where you will trade. Because many beginner trader do what? They come on Asia session, make $300. Okay, for example, a person come on Asia session and he make $300. Then again he come on London session, he make more $300. Okay, and then he come on New York session and lose what? $1,000. Yes, he lose $1,000, even blown his whole account, and also lost what he has made. Because most guy make this mistake, because forex market is open 24/7. So they come on Asia, they come on London, and they come on New York. They did all session, and therefore they don't even know that what time is the best for their trading. Therefore, my recommendation is stick to one trading session, and especially stick to kill zone. I can't explain kill zones in this video, because if I explain here it will get so long, 40 to 50 minutes, and you will get bored. Therefore, comment down below kill zone and I will make a detailed video on kill zone. So for recommendation and simplicity, I will say you that stick to one trading session. It can be New York session, it can be London session, it can be Asia session. Whatever your data says that best for you. Don't trust anything. If your data says that New York session is best for you, trade on New York session. If your data says that Asia session is best for you, trade on Asia session. My data says that my strategy works in New York session. Therefore, a random guru trading on London session, I don't care about it. Therefore, trust your data. Trade based on your data, not anything else. So stick to one trading session, what your data says is best for you. Now, let's get to point number 3. Now, our third point is risk to reward ratio. What is risk to reward ratio? Risk to reward ratio is how much are you willing to make on the amount of you are risking. So, in risk to reward ratio, we are gonna cover two topics. How much you should minimum aim for risk to reward ratio. What should be your aiming? Means what is your minimum risk to reward ratio and what should you aim for, and where to scale in your trade, and how much risk you should put on a scaling trade. Okay, because if you are scaling at a wrong place, you will lose. double amount of money what you are losing. But if you scale at a right place, you will make double amount of money what you are making. And risk management, risk per trade is also so useful in a scaling trade. So these are the key topics. Aim for minimum 2 hour, but my recommendation is aim for minimum 3 hour. I will show you why, and then we will cover where to scale and how much risk we should put on scaling trade. So first, let's understand risk to reward ratio. So this is the chart of risk to reward ratio, and these are the key risk to reward ratio which in trading people uses. So this is less than 1:1 risk to reward ratio. It can be 0.8 or like that. Okay, it is less than 0.1 1:1 hour. And everyone in trading industry, everyone will say, and even I am saying, don't ever take a trade which is giving you less than 1:1 risk to reward ratio, because it is not profitable. In the long run, it will make you a loser. No one follows less than 1:1 reward ratio. If a fake guru giving you a scalping strategy which have 90% win rate and it is giving you less than 1:1 reward ratio, leave it. It is not profitable. Okay, so let's remove it. It is not useful. Now these are the 3 risk to reward ratio which you will understand. So our first is 1:1 risk to reward ratio, and second is 1:2 risk to reward ratio, and third is 1:3 risk to reward ratio. Okay, now our first risk to reward ratio is so unprofitable. Many scalpers uses this, that they should aim for 1:1 risk to reward ratio. Okay, so let's continue because there was a technical issue. So these are the 3 risk to reward ratio which we are gonna focus on. So this is our first 1:1 risk to reward ratio. Second is 1:2 risk to reward ratio, and 2, yes, and third is 1:3 risk to reward ratio. Now let's get to our first risk to reward ratio. Our first is 1:1 risk to reward ratio. Means if you are risking $1, you are making back $1. Means the amount you are risking, you will make back what you are risking. So in my recommendation is don't take 1:1 risk to reward trades, whether you have a 90% win rate or 95% win rate, because in long run it will blow your funded account or a live account. When will I forget my habit of saying funded account? Okay, let me show you why 1:1 risk to reward ratio is not profitable. Because for example, this is your account and it is at $100. Okay, you win one trade, you are at $101. Okay, $101. And again you win one trade, you are at $102. And then suddenly market condition changes and you hit a losing streak. You lose one trade, you are at $101. You again lose a trade, you are at $100, break even. But then you again lose a trade, you are at $99. You again lose a trade and you are at $98. But if you wanted to recover this whole loss, you have to make back 4 wins in a row. Means if you win 4 trades in a row, you will recover it. But how it is possible? Yes, you can win 4 trades in a row, but in long run you have to make again a winning streak. You should have winning streak to recover losses in 1:1 risk to reward ratio. But at that place, for example, you are using 1:2 risk to reward ratio. For example, you have 1:2 risk to reward ratio. Okay, let's understand. And you are same using $100 account. You win a trade, you are at $102. Okay, up 2% because you are risking 1% and making back 2% because your risk to reward ratio is 2R. Then again you win a trade, you are at $104. Okay, now even if you hit a losing streak and lose 6 trades in a row, let's get example. Okay, you lose 6 trades in a row, now you are at $98. Okay, in prior and 1:1 risk to reward ratio, you lost 4 trades in a row and you wanted to make again 4 wins in a row to recover it, but you lost 6 trades in a row and now you are down 6%. Okay, in technically you are down 2%, but by profit PNL you are down 6%. Okay, now if you wanted to recover this 6% loss, you only wanted to win 3 trades, and that's not also back to back, so get to. Okay, you win one trade, you are at $100. Okay, then you lose a trade, you are at $99. Now back to back you win 2 trades, now you are at 99, 101, then 103. Yes, you are at again at the point where you started. But why I recommend using 1:3 reward ratio? Because 1:3 reward ratio is more better. Let's understand. Okay, for example, if you are using 1:3 reward ratio here, you win a trade, you are at 103 plus 3%, because you are risking 1% per trade and making back 3%. Okay, then you lose back to back 10 trades in a row. Okay, now you are down 7%. Okay, so you are at $93. Okay, now if you wanted to recover this 10% drawdown, you wanted to make back what? You win a trade, you are at $96. Okay, you again win a trade, you are at $99. You lose a trade, you are at $98. Then you again win a trade, you are at $101. And for example, you again win a trade, you are at $103. See how easy it is to recover a loss if you are using a high risk to reward ratio. Therefore, I am recommending you to use a high risk to reward ratio like 2R, like 3R or 2R. My recommendation is never ever take a trade which is giving you 1:1 reward ratio. Never ever take a trade which is giving you risk to reward ratio less than 2R. Never ever take a trade which gives you risk to reward ratio less than 2R, whether it be 1:1R, 0.8R, whatever. Whether you are checking off every single criteria in the world, but don't take a trade, because taking a trade which gives you less than 2R in long run, that will make you an unprofitable trader. So I have a strategy. Have a proper structure rule that I will not take a trade if the risk to reward ratio is less than 2R, and I will also aim for minimum 3R. But if I can't get minimum 3R according to the technical setup, I will aim for 2R. That's the setup. That's the rule which I personally use, and always aim for higher risk to reward ratio. The more higher the risk to reward ratio, the more better the trade is. Okay, now let's get to the chart work, where I will explain you on chart that what is risk to reward ratio and where to scale and how much you should risk. We are on chart, and now we will understand that what risk to reward we should take on charts and where to scale and how much we should risk. Okay, so for example, this is the charts we are gonna trade, and you are waiting for a liquidity sweep. Price give you a liquidity sweep and you enter here. You set your stop loss here. Now, for example, you are setting a stop loss here because you are afraid of losing, because you think that price will not get here. But this is what? 1:1 risk to reward ratio. 1:1.3 means it is less than 2R. Don't take a trade. Don't ever take this trade. Skip this trade. But for example, if you are so aggressive and you are gonna target the next low, okay, next low in swing trend, okay, so you target this low. Okay, now you have 10R. That's so better because it is high risk to reward ratio. So that is what? Don't take a trade which gives you less than 2R. Only take a trade which gives you minimum 2R and aim for minimum 3R. And the more risk to reward ratio, the better. Okay, now if you entered here, the price is going down, 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 down. Okay, now where to scale? So only scale at a high probability area. But what are the high probability area? The high probability area are the point of interest, the zones, supply demand zones, order block, liquidity zones. But what are the high probability point of interest which we should enter? So the criteria which a point of interest should check is it should lead to a liquidity sweep and it should lead to a breakout structure. That are the two criteria which a point of interest should check, and only enter at a point of interest which checks off these two criteria. It should sweep liquidity and it should lead to a breakout structure. So this is the point of interest. So it swept liquidity, gave us a breakout structure. So we will mark it as our point of interest. Okay, if you want a detailed in-depth video of how to mark high probability point of interest, comment down below point of interest and I will make that video soon. Okay, so now we are waiting for price to mitigate this point of interest. Okay, price didn't mitigate this point of interest, then gone down. Okay, gave us another point of interest. This point of interest sweeps liquidity, gave us a breakout structure. Okay, so we will mark this point of interest. So we mark this point of interest and now we are waiting. Okay, price mitigated this point of interest. We will enter here, set our entry here, set a stop loss above it, and then target the next swing low. Now see how beautifully the trade is going. It will eventually hit our TP. Wait, whether it hits our TP or not. Let me make the charts faster. 10x. Oh, it's getting boring. Yeah. Okay, it literally came below. Okay, so market are open here and it can hit TP at any point. So for example, we have set a stop TP here. So it has hit a TP. You can see on our initial trade we are making 8R. It is, if we round figure, it is 9R. But by scaling in, we made extra 5R. That's 14R. We are making 9R, but we made 14R. That's what scaling is. So there were two topics: how much we should risk on the scaling trade and where to scale. So where to scale? Only scale at a high probability area, the high probability point of interest. So a high probability point of interest where you should enter on your scaling trade is the point of interest which checks off these two criteria. It should lead to a liquidity sweep and it should lead to a breakout structure. Only enter at a high probability area which checks off these two criteria. Now, how much you should risk on a scaling trade? It is so simple. So let's get to the board to understand deeply. Okay, how much we should risk on a scaling trade? Why the internet connection gone? Yes, it came back. Okay, how much you should risk on a scaling trade? You should risk the half amount of risk which you are risking on your initial trade. So for example, you enter your first trade here and you are risking 1% on this trade. Okay, and then you enter a scaling trade at this point of interest which checks off breakout structure and liquidity sweep, checks off criteria of high probability area. You enter here. Now how much amount of money you will risk here? You will risk half of the amount which you are risking on your initial trade. So if you are risking 1% on your initial trade, you will risk 0.5% on your scaling trade. Okay, that's the rule. Only enter at a high probability point of interest in your scaling trade which checks off every single criteria of point of interest, and the criteria are breakout structure and liquidity sweep. And how much you should risk on a scaling trade? You should only risk half of the amount which you are risking on your initial trade. That's it. Now get to our point number 4, trade management. Now our last and final topic is trade management. What is trade management? Trade management is how you manage your trade, and in trade management we have our two topics: stop loss and take profit. So I will not explain that on this board. I will get you live example on charts. So for example, this is where you wanted to enter. This is the point of interest where you wanted to enter your trade, and You will wait for liquidity sweep. Okay, you wait for liquidity sweep and you enter here. Now where to place your stop loss and where to place your target. So the simple rule for stop loss is set your stop loss at the area which invalidates your trade idea. Means set your stop loss at the area where your trade idea proves wrong. For example, okay, we entered here. Now to prove that this setup is wrong, if price break past this high, means this is the break of structure which confirms us that the trend is making lower highs and lower lows. So if this high has been broken, means the lower highs and lower lows trend has been shifted to higher highs and higher lows, means to invalidate a trade idea and prove that the trend has been shifted to bullish again, we wanted for price to break past this high. So we will set a stop loss above it. But most people make this mistake that they set the stop loss so tight for high risk to reward ratio. But the recommendation is set your stop loss above 2 to 3 pip above your entry. Okay, so for example, if I wanted to set my stop loss here, I will give it a little bit of breathing room, so that if even price came up to sweeps liquidity, my stop loss is protected. Now where to place your target? So place your target at a logical level. Simple rule is be pessimistic in your stop target. I don't know that quote, so simply set at a logical level. For example, if the rule is target the weak point means I have told you that in uptrend the lows are strong and the highs are weak, but in downtrend the highs are strong and the lows are weak. Okay, so this is a downtrend, so the high is weak, the low is, means the high is strong and the low is weak. The high is strong and the low is weak. So where we will target? We will target the low, because this is downtrend and the lows are weak. So I will simply target the low and then see how beautifully our trade goes. Ching, the money ching sound, how beautiful it is. Okay, so have you understood that where to set your target and where to set your stop loss? Set your stop loss at a point where it invalidates your trade idea, means where your trade idea proves wrong, and set your target at a logical level. Set your target at a weak point. Okay, in uptrend the highs are weak, and in downtrend the lows are weak. Okay, and if you wanted to be more pessimistic, you can target the next point of interest. Okay, or it anything. Okay, that's on you. Now our risk management guide has been over. Let's get to a quick summary. Now, the quick summary for the risk management guide 101 is this. But before it, I wanted to give you a big round of salute to the guys who are still watching this, because this video was boring and so long. I think it is 30 to 40 minutes. But the people who are still watching this, they have the courage to change their life, to change their family life, and to change their bloodline's life. And I really salute them for their focus and for their attention and for their patience to watch this whole video. I really salute it, and I guarantee you that you will become a profitable trader and successful trader and change your family's and bloodline's life. So the summary is, so at first we covered the topic of risk per trade, where we understand that how much money are you willing to lose on a single trade, and I recommended that only risk 1 to 2%. That's the journal rule which trading industry says. But I recommended that when your account is down 2%, decrease your risk to 0.5%, and when your account is at break even, risk 1%, and when your account goes to 2%, when your account is plus 5% and plus 5% profit, increase your risk to 2%. That's what I recommended you. Then we get to ceiling, where we covered max trades per day, max losses per day, and fixed trading window, where I recommended that take a max trades of 3 to 5 trades per day, because it saves you from over trading and revenge trading and taking random trades on emotion. Then we understand that max losses per day. So I recommended that only take 2 to 3 losses on a single day because it saves you from over trading, revenge trading, and taking trades on emotion just to recover your loss. Then we covered fixed trading window, where I recommended that only trade on a fixed trading time where the markets give you most amount of volume, where we covered kill zones. I didn't explain here because it video will get so long. Therefore, comment down below kill zone to make a detailed video on kill zone. Then we came to risk to reward ratio, where we understand that why risk to reward ratio less than 1 is not profitable and 1:1 is not profitable. We said that target minimum of 2 hour but aim for minimum 3 hour risk to reward ratio. And we said that the higher risk to reward ratio, the better. Then we understand that scaling, how much risk we should put on a scaling trade. I recommended that only put 50% less risk to reward ratio which you are risking on your initial trade. For example, if you are risking 1% on your initial trade, risk 0.5% on your scaling trade. Then you understand the way to scale. Then I said that we should only scale at a high probability area, at a high probability point of interest which checks off these two criteria. It should lead to a breakout structure and it should lead to a liquidity sweep. Then we understand that trade management, where we understand that where to place your stop loss and target. So I told that set your stop loss at a price point which invalidates your trade idea, which proves that your trade idea has gone wrong. Okay, and then I said that give your stop loss a little bit of breathing room. It can be 2 to 3 pips. Okay, anything. Then we understand that where to place our target. I said that set your target at a logical point which is weak. In uptrend, the highs are weak, and in downtrend, the lows are weak. So the whole risk management masterclass ends here. But risk management is useless if you don't know where to trade. Comment down below market structure and I will make a detailed video on market structure so that you know that where you wanted to enter. So you can take trades with trend and make shit amount of money, the high risk to reward ratio. Because to get the high risk to reward ratio, you should not be trading randomly, selling in uptrend. You should take trades with trend, with the structure. Comment down below masterclass and I will make a detailed video on masterclass. Subscribe the channel and hit the bell icon button. And our series is running of 30 days trading discipline challenge. So see that series because that is so amazing. I explained there that how to become a disciplined trader. And bye, and I will see you in next video. Till then, bye.